To the phones we go. Tom in Homa. You're on Winning at Life with Gregory Ricks. How can we help you, Tom?
Hey, I would just listen to what Gregory was saying about people that don't like risk. I had a coworker in Harahan back about 2000, and he had a good job, and he lost a bunch of money like everybody did in the downturn of 2000, and then he got a big job, six-figure job with the federal government, making big money. He never again put any of his money in the stock market. He kept it all in fixed. And that's 21 years ago. And I think he's done pretty well because I think he makes enough to put away quite a chunk. But he's absolutely, I've talked to him before. I said, you got to put it in an index fund or something. No, I don't want to take any risk. So what are you going to do?
Well, if you look at, for example, let me just say, when we kind of talk about the bond market, say being lower risk, when you look at the Barclays bond average over the past 45 years, it's just above 7%. Over the past 20 years, bonds are lower. They're just under 5%. So it's not like you don't have a choice or money's not going to do anything. Did the market average more? Yeah, a few percentage points. Go ahead. Your question, Tom.
I've been kind of an amateur investor for about 30 years, and I've heard people say never average down when you're buying a stock. And I've always thought, well, okay, I've got my eye on this stock. Look, a good example recently would be Apple. I'm watching Apple. It was 144. Now it's 121. Okay, suppose I want to buy 100 shares. I'll buy 40 shares now at 120, and maybe wait and buy another 40 shares at 115. Of course, it's going the other way now. But people say, a lot of experts say, never average down. You're catching a falling knife. You're throwing good money after bad. Set a point where you want to buy it and then just buy it. But I've always thought in a downtrend, don't buy everything at once. You might get a better deal on the next part.
What you asked something actually that's very complicated, because if I was, and we've run different systems in my 30 years of doing this as a money manager, and we were even looking back at some of the strategies when we were actually doing stock selection for portfolios, and look back and it's like, man, that was some solid stuff that we were doing. But here's the difficulty of that. It's not just simply looking at Apple. I would have to look at a number of technical factors to make a decision to buying. And then how much of your portfolio is tied up in that one stock? You probably are going to be overweighted into that, which could be hazardous because, GE used to be like considered one of the greatest companies on the planet ever. And what we've seen the past decade is it's been one of the biggest train wrecks ever. Not saying that Apple will become that, but you don't know how things are going to look 10 years out. Now, if we're doing into the market, say the S&P 500, and it's moving down and you have a long-term view, we have a diversification of 500 companies there. I don't mind pushing money in as it's moving down, and then it hits that bottom and the V side where it starts coming up, and even adding money, because if we're taking a long view of money, meaning our view should be, if we're in stock, should be a few years out and not get bothered by movement if we have multiple asset classes. I think you're better off with that strategy. And the thing is, you got to have some certainty that stock, as you're throwing money into, investing into is a better way to say it, and expecting it to come back up, because there's that other side of this, and I'll give you one of the core rules. History has shown us most stocks do not outperform 30-day treasuries. Now, with that said, Apple has absolutely outperformed. Okay, Tom, continue.
That's good advice. I just, some people say absolutely do not chase a stock lower. You know, if you made a mistake, you're just compounding your mistake. But I don't think absolute rules work very good on the stock market.
No, they don't. And you can say some situations are like that. Some there's opportunities for it where they come back, and that's why there's a number of things you should be looking at to do that. Because otherwise, if you're just kind of saying, "Yeah, I like me some Apple, I get a new iPhone every year," you might have some emotional attachment to it, which could hurt you in decision making there, Tom. So investing is a mix of things, and that's why I think you should be broadly diversified. Indexing skews a higher return is what historicals show us as well, so we should keep that in mind. And if we do want to buy some stock, do be careful of not getting overweighted in that, and have a long-term view. But you also sometimes you have to cut bait and move on. You get that, huh?
Right.
Yeah.
Right.
Thank you, Tom.
Thanks so much.